Look, you need to listen closely because this sounds absolutely bonkers. The entire multi-billion-dollar silver trade just got completely dismantled by a single post about purchasing Greenland. Yeah, you heard me, Greenland. And while the internet is cracking jokes, the financial giants on Wall Street are sweating bullets. What I'm telling you will shatter your perspective on silver permanently. Whether you are stacking bullion trading futures or just trying to safeguard your savings, you cannot afford to miss a second of this. But before we start, do me a solid. Smash that subscribe button and ring the bell so you catch every update. Believe me, you need to track this saga live. Drop a comment below saying, "I'm watching the real money," and just to prove you're awake. Okay, let's dive in. Picture it. January 18th, 2026. Sunday, markets are dark, folks are chilling, maybe catching a game or doom scrolling. Suddenly, Trump drops a massive bombshell. He is trying to buy Greenland again. The press instantly mocks him. Comedians have a field day. Danish leaders are furious. It feels like a circus, just another wild headline in a chaotic world. But here is the secret. Hidden inside that drama is one specific line that just nuked the global silver market's entire foundation. The president slapped a 10% tariff on imports from 8 European nations, the United Kingdom included. This tax hits February 1st, and if the Greenland deal fails by June 1st, it spikes to 25%. To the average Joe, that is just boring politics. Another tax. Another power play. But if you know how silver mechanics actually function, you just witnessed a financial explosion. Let me break down exactly why this is critical and why risk teams at huge banks like JP Morgan and HSBC are absolutely panicking right now. The whole silver game relies on fungibility. That is just jargon, meaning metal. In London is identical to metal in New York. A 1,000-ounce bar in a British vault must equal a 1,000-ounce bar in Manhattan. Crucially, the system needs to move that metal back and forth instantly and cheaply. Banks exploit this loop. When New York prices scream higher due to demand, they pull reserves from London, specifically the LBMA vaults, and ship them to the States to flood the zone and crush the price. When London runs dry, which is happening right now thanks to massive buying from Asia, they drain the COMEX in New York and send it back across the pond. This constant Atlantic ping-pong match is their price control weapon. It lets the banks fake abundance by shuffling the same deck to wherever the fire is. But what happens when you drop a 10% tax wall in the middle of the ocean? The UK is on that hit list. The LBMA is British. London is the hub. So from February 1st, if a US bank moves metal to London to bail them out and tries to bring it home later, they get slapped with a 10% import fee. With silver at $90, that is a $9 penalty per ounce. That obliterates the profit. It renders the arbitrage trade mathematically dead. Trump effectively just flipped. America's border just turned into a silver lobster trap. Bars might slip in if they hail from friendly spots like Mexico exempt from tariffs, but that metal absolutely cannot exit for London. If it leaves, it faces a lethal penalty to return a cost that destroys all banking profits instantly. We are witnessing a total inventory lockdown right now at this very second on a Sunday. Risk. Officers at every major bank are staring at this news in panic and slamming the brakes. They are screaming at logistics teams to freeze exports now. They simply cannot gamble on shipping bullion to the UK if it's trapped there. This severs the LBMA from the COMEX. It snaps the link between the planet's 2 biggest pricing giants. And listen to this, the timing could not be more catastrophic for London. Looking at the vault depletion data that insiders are watching, London is running on fumes. The relentless drain to China and India has sucked LBMA vaults down to historic emptiness. They were praying for a massive New York haul to save their skins. Just last Friday, over 4 million ounces were ripped from the COMEX. That stack was destined for a flight to London. It was the cavalry arriving to save the day. But thanks to this tariff shock, the rescue mission is aborted. The silver meant to fly across the Atlantic is now grounded on U.S. soil. This changes the entire game board. If London is cut off from American supply, and miners are tapped out, where on earth do they find metal to cover their shorts? They don't. London hits physical default way faster than the crowd believes. This Greenland tax is a classic black swan disaster. No one saw it coming, no one hedged for it, no model exists. The high-frequency bots moving billions in paper silver daily are coded to watch yield curves, the dollar index, and factory output. They are not coded to process a geopolitical real estate fight over Arctic ice. This is exactly why human instinct is king. It is why you are tuned into the money vault instead of skimming generic news. Algorithms see a trade spat. We see a liquidity death spiral. Make sure you subscribe because this crisis is accelerating and you must stay ahead of the curve. Smash that like button too. It helps the masses find this vital intel. Now listen close. Let me tell you what comes next. The banks are staring down a fatal dilemma. They must choose which empire to defend. Keep the bullion in New York and let London burn, or ship it to the UK, trap it there forever, and leave the COMEX defenseless. They cannot save both. Since most banks are US-centric or have deep roots in America, the choice is made. They will protect the COMEX. They will fortress New York. This leaves the LBMA totally naked against the Asian vacuum. Shanghai is inhaling every bar it can find, and now the American lifeline is severed. We are witnessing the impossible unfold, a total split of the Western silver market. We could see silver hit $90 in New York while hitting $110 in London just because metal cannot cross the ocean between cities. The law of one price was just killed by a pen stroke. Imagine how insane that is. The same bar priced wildly different in two major markets, and that tariff wall makes arbitrage impossible. Okay, let's dive into the key mechanism behind this trap. You see, in the commodities game, we use something called a location swap. Usually silver moves freely. Say JP Morgan is overstocked in New York but short in London. They don't just ship it over. Instead, they usually execute a swap. They exchange New York bar titles for London ones with a counterparty. The assumption is that the metal can eventually be shipped to balance the books penalty-free. This whole system hinges on an ounce of silver having equal value on both sides of the ocean. That 10% tariff. It just destroyed that logic. Trump transformed the U.S. bullion scene into a classic roach motel. Remember the tagline, roaches check in, but they never check out? Well, silver checks into America now, but it stays put. Here is the nightmare scenario keeping Wall Street risk managers up at night. Imagine you are a bullion banker. London is screaming for silver. You want to move 1 million ounces from your COMEX vault in NYC to your LBM. Stash in London to crush a price spike. Getting it there. Simple, no export tax. Throw it on a jet land at Heathrow, be the hero. In London. But what happens next month when COMEX is empty and you need that silver back in New York to cover futures? Now you are facing a disaster. Since that silver is arriving from the United Kingdom, U.S. Customs slaps it with a 10% tariff. If silver trades at $90, you pay Uncle Sam $9 per ounce, you repatriate. That $9 eats your margin alive. In the slim margin game of bullion banking, a 10% hit isn't a loss, it is fatal. It obliterates your potential profit 10 times over. So the risk officer stares at the screen and screams, "We can't ship that silver to London." Once it leaves U.S. dirt, it costs 110% to bring back. That silver is hostage. This wrecks the entire game banks have played for years. No more smoothing out volatility. If London hits $120 and New York sits at 90, banks can't close the gap because that tariff wall stops them cold. It creates a segmented market. We are going to see radically different prices for the same asset based purely on where it physically sits. Now here is where it gets spicy. This could be accidental brilliance. The media obsesses over Greenland. They think it is about ego real estate or Trump antics, but look at what the policy actually executes, not the headlines. By locking silver inside the United States, Trump effectively built a domestic strategic stockpile. Experts have screamed for years that America must secure critical minerals for national defense. Everyone worried the U.S. Mint was running on fumes. Well, this tariff fixes that instantly. If banks can't ship silver to London due to tax risk, that metal stays put. It sits in COMEX vaults. It remains ready for Tesla and their EVs. It remains ready for Raytheon and defense contractors. It stays on hand for the mint to strike coins. It forces what scant inventory stays locked inside American territory. It is patriotic economics hitting the elemental charts hard. It compels foreign nations, particularly the European zone and Britain, to scramble for survival alone. It screams at London, "You are solo now, no more looting our stockpiles to rescue your market." This throws the LBMA into a terminal tailspin scenario. London serves as the nexus for planetary silver deals. Most bullion streaming toward India and China channels through that British hub. If the city gets cut off from American reserves, their safety net vanishes. We realize their storage is running on fumes. We realize the liquid supply is dry, and now we see the lifeline has been severed. That is why those 4.2 million ounces pulled from the COMEX last Friday matter so much. Back then, everybody assumed that bullion was exiting the States bound for Britain. But with this surprise tax declaration dropping on Sunday, that payload is likely stranded. It is likely idling at a depot near JFK Airport, swathed in shrink wrap with no place to move. The holder of those bars faces a dilemma: export to London and eat the looming duty costs, or hold it stateside and vend to a local purchaser. Considering the chaos, the brilliant play is clearly to keep it domestic. This implies the supply crunch inside America could soften just a fraction in the immediate short run. However, the shortage in London is primed to go absolutely ballistic. And since silver acts as a world asset, if the city cracks, the whole matrix shatters. You cannot see prices at $200 in Britain and $90 here for long. The hysteria will ripple out, the terror becomes infectious, yet there is another dimension to this supply chain snare involving the processors. A lot of key bullion mints feeding American buyers are based in Europe and Canada. If this levy hits imports from those countries, then incoming silver, ingots and coins just became 10% pricier in a flash. This hikes the restocking expense for American shops. If giants like APMEX or JM Bullion need to source metal and the national mint is shuttered or empty, they tap private producers. However, those independent shops source raw ore from processors. If those sources are European, the price of that input just leaped 10%. That bill is pushed straight to you, the buyer. So even if paper charts hold at $90, the surcharge you cover for real metal in America is poised to spike massively. Retailers must factor in the tax. This confirms the inflated street values folks have been witnessing. The duty sets a basement for markups. It cooks inflation right into the tangible good. We are observing the fragmentation of the monetary sphere live. The seamless worldwide commerce of the past 30 years is finished. We are stepping into an era of barriers, levies, and seized wealth. Drop a comment and let me know if you are stacking real bullion at this moment, or if you are planning a purchase. I need to hear your take, and blast this clip to everyone you know who is holding hard assets, because they must grasp what is unfolding in this brave new reality. Holding tangible bars in your personal grip is the sole true security. You never want a paper claim in London if the city cannot secure shipment. You cannot trust an ETF vaulting its gold in a zone that is in the crosshairs of a tariff battle. You need the loot in your palm and safe under your command. The Roach Motel dynamic implies that any bullion crossing U.S. lines, the wealth is not escaping. It is being seized by the state, by the big lenders, and by corporate giants. This snare is flawlessly designed. It paralyzes the institutions instantly. It halts the hustles. It makes them reveal their cards. And once those cards flip, everyone will witness that they are gripping mere worthless IOUs. Now let us swing our attention over the pond to the UK and discuss exactly how brutal the opening bell is going to look next week. The LBMA stands as the absolute core of the worldwide tangible silver exchange. While the COMEX in the Big Apple is basically a betting parlor for wagering on charts, Britain is where the massive delivery contracts truly get finalized. Hard assets swap owners there. For the past 3 years, the city has been hemorrhaging. We have seen a non-stop drain of bullion from UK storage heading straight for Asia. The stockpiles in Britain have plummeted to points that most experts deem dangerous or arguably catastrophic depths. The volume of available bars stuff not already claimed by a fund or tagged for a client is terrifyingly scarce. The market has been hanging by a thread. That thread was the power to ship in supply from the states when supplies got thin. Whenever the British safes emptied, they could ring the major players on Wall Street and beg them to fly over tons of product. And the dealers would comply. They would run a swap deal and keep the charade alive. But just yesterday, the president severed that cord by slapping this 10% tax on British goods. He rendered that trade financially poisonous. 0 Wall Street firms will fly bars to Heathrow if they must eat a 10% fine to return it later. So the city is now stranded both geographically and economically. They are severed from the futures market. They are severed from the southern production lines, yet they still face totally unquenchable hunger from the Orient. This triggers a panic mode in the financial district. As the sun comes up on Monday, dealers across the pond will wake up to find they are bust regarding real assets. They have paper sold more metal than they actually possess, and the cavalry from America is not arriving. This is the formula for a regional collapse. We might witness a scenario where silver values in Britain totally decouple from the rates in the States. We could watch the metal sitting at $90 here, but $110 or $120 there. Why? Because in the UK, the commodity is physically rarer, and since it cannot be balanced out thanks to the levy, that spread will remain. This destroys the notion of a unified world market rate. If you see one tag in China, a different one in England, and a third in Manhattan, which is the true value, the answer is the place where you can physically get the goods in your hand. The splitting of this trade is a total catastrophe for the houses because it wrecks their risk strategies. Most firms manage a so-called universal ledger. They might be long in Britain and short in America. In a standard environment, these bets wash each other out. They are covered. Danger is neutral. But if the rate in Europe rips upward while the U.S. remains level, their safety net shatters. They begin bleeding cash on the gap. This compels them to dump their stakes. They must cover their shorts stateside and dump their longs across the pond. This triggers a purchasing frenzy in the U.S. So strangely enough, the tax that locking bullion stateside actually ignites domestic values too. Major lenders are forced to grab Manhattan futures, hedging against a British implosion. Thus, the notion that stuck stockpiles might tank American rates is totally false. It triggers frantic buying as institutions rush to fix their shattered ledgers. Now consider those phantom holdings in the UK. Millions of global traders possess paper silver through these massive bullion giants. It is basically a Ponzi scheme for commodities. You hold 0 physical metal. You hold a promise the vault claims exists. When British vaults lose fresh flow, the danger of total collapse goes vertical instantly. If you own phantom ounces across the pond currently, you are clutching a worthless receipt from a firm that lost its key. Source: once the street sees the UK is cornered, anticipate a brutal stampede on these virtual positions. Traders will sprint to swap digital notes for real heavy ingots, yet supply is woefully insufficient. This compels brokers to hit the streets desperate for any scraps they can locate. This is exactly how a cash crunch mutates into a bankruptcy event. That Greenland tax revealed how incredibly brittle this world network is. It proved the bullion trade isn't a single sea. It is a chain of linked ponds. Currently, Britain dries up while Manhattan floods with stuck assets unable to escape. This renders the American exchange the safest bullion haven on earth. Owning real metal inside the States means possessing critical wealth. However, holding digital bets in the UK means carrying a debt bomb ready to be triggered. The gap between these hubs will unleash total anarchy. By Monday, open watch for algorithmic trading systems to crash hard. Spreads will explode to gaps that defy logic. This is the result of broken supply chains. The value signal dies, and recall those 4.2 million ounces we mentioned pulled from the vault last Friday. We are practically sure that stack is trapped. The holder of that loot sits on a Manhattan hoard they cannot ship without eating a 10% hit. So their move: they are going to sit tight. They wait, or sell locally to giants like Tesla, or perhaps the Mint. This implies that local American stock could steady itself, though, at a screaming premium. The tax snare is the final accidental disaster. A fight over an Arctic rock has sparked a likely catastrophe in the British capital. It demonstrates how suffocated this trade really is. In a sector running on empty, a tax is a match in a dynamite factory. Britain burns, the link is severed, and flames are leaping. So what is the impact down the road?